Were you moved at all by this this inversion, either on 2s, 10s, or I see new lows today on 10s, 3-month?
Yeah, I mean, when the yield curve inverts, you have to pay attention. But it inverted this time because the long end went below the short end. Ordinarily, the inversion is the Fed tightens because of inflation in an overheated economy, and the short end goes above the long end. But this time, it inverted from the back end, and I think that is different. And the reason for it is there's so much liquidity out there that's looking for a place to park until the outlook clarifies. And so you had a lot of money created in the last decade. Central bank balance sheets went from $3 trillion to $16 trillion, and some of that money wants to hide out until the market outlook clarifies.
All right. You were with us on July 11th. You said the Fed's mandate is full employment and low inflation. And we have full employment and full inflation, so the Fed needs to do nothing. You still feel the same way?
That is still the way I feel, but that is not what is going to happen. The Fed is very sensitive to markets. It's worried about a strong dollar, and it's already cut rates once, and I think it'll do it at least one more time.
What's that going to mean for the market?
From an economics, from an economic standpoint, I don't think it needs to do it. The economy is still doing well. It doesn't need additional stimulus. And I don't know how much cutting rates will stimulate the economy anyway. If you wanted to borrow for a project, rates are already low.
So, I mean, I guess the question is, what does it mean for stocks? Does it help ease the pain, for instance, when we get these trade headlines that the market reacts negatively to?
Yeah, if you look at the market over the past week, the stocks don't need any help. They're roaring ahead without the Fed doing anything. Now, maybe there's some anticipation that the Fed is going to act, but I think the stock market is fine. I think the economy is doing well. You look at retail sales at Walmart and Target. This is a 70% consumer economy, and the consumer is spending. Unemployment is low, wages are rising. So the situation right now is very favorable. It may change. It could change abruptly, but right now we're in pretty good shape.
Byron, Germany's floating deficit spending, fiscal stimulus. We're wondering if Draghi's going to buy bank stocks. We're talking about the Fed here. The White House is floating tax cuts. Does all this feel normal to you?
No, I mean, nobody wants another recession. If we get into another recession, we're going to have a hard time getting out of it. The usual tools are fiscal and monetary policy, and we already are running a big budget deficit, and monetary policy had shifted from accommodative to neutral to negative. I just don't think we have the traditional tools to deal with a recession. So the policymakers are going to try to defer the next recession as far out as possible. And that's true in the United States, and it's also true in Europe.